Welcome back to CMA USA Exam Coach, your study companion. Today we are going to discuss an important concept, the contribution income statement. But before we get into decision analysis, let's first understand what a contribution income statement is. And before that, we'll take a quick look at the various areas covered under decision analysis, so you have a clear idea of what kind of decisions managers deal with in this section.
Let's begin with a quick overview of decision analysis. Decision analysis is all about helping managers make the best possible choices in different business situations. It involves analyzing costs, revenues, and possible outcomes to decide which option will benefit the company the most. The main goal of decision analysis is to reduce unnecessary costs and maximize profits, while also improving the efficiency of operations. Whether it's choosing between products, deciding on pricing, or evaluating whether to make or buy a component, decision analysis gives a structured approach to finding the most profitable and logical solution. Now, let's look into the major areas where managers are required to make key decisions. Pricing: managers must decide how to price products and services in a way that attracts customers while still ensuring profitability. This involves analyzing cost structures, competitor pricing, customer demand, and profit margins to set a price that supports the company's goals. Alternative manufacturing process: when multiple production methods are available, managers must evaluate the costs, efficiency, and quality of each process. The goal is to choose the most cost-effective and reliable method to maintain product standards while minimizing production costs. Research and development: investing in research and development involves decisions about how much to spend, what areas to explore, and the potential long-term benefits. These decisions are critical for innovation and future growth, but they also involve significant risk and financial commitment. Marketing decisions involve how much to spend on promotions, which channels to use, and how to position the product in the market. Managers must balance cost with expected return to ensure the marketing efforts lead to increased sales and brand value. Distribution: managers must choose the best way to deliver products to customers, whether through direct shipping, retail partners, or regional warehouses. The decision impacts both cost and customer satisfaction, so choosing the right distribution strategy is essential. Contract negotiation: when entering into agreements with suppliers, customers, or partners, managers must negotiate terms that are both fair and beneficial. This includes pricing, payment terms, delivery timelines, and responsibilities, all of which can significantly affect profitability and risk. Outsourcing decisions: sometimes companies must decide whether to handle operations in-house or outsource them to third parties. This involves evaluating costs, expertise, control, and quality. The right outsourcing decision can reduce costs and allow the company to focus on its core strengths. Capital budgeting and disinvestment decisions: these are long-term investment decisions where managers must evaluate whether to invest in new projects, buy equipment, or expand operations. On the other hand, disinvestment decisions involve shutting down or selling parts of the business that are not performing well. Both require careful financial analysis and forecasting. So now we understand the major decision areas that managers are involved in. In Section C, Decision Analysis, we will explore how managers analyze these decisions in detail. This section focuses on the tools and methods used to evaluate each alternative and support decision-making with data-driven logic. From analyzing costs and revenues to using models like cost-volume-profit analysis, break-even analysis, relevant costing, and more, you'll learn the techniques that help managers choose the most profitable and effective course of action. So, let's quickly cover the tools and methods used in decision analysis. One of the most important tools is the cost-volume-profit analysis, commonly known as CVP analysis. This method helps managers understand the relationship between costs, sales volume, and profit. By analyzing how changes in selling price, variable costs, or sales volume affect profit levels, managers can make better decisions about pricing, production levels, and cost control. Under CVP analysis, we will be covering the following key areas. Break-even quantity. This tells us the number of units a company needs to sell to cover all its fixed and variable costs. At this point, there's no profit or loss, just a break-even. It helps managers understand the minimum sales needed to avoid losses. Break-even revenue. Similar to break-even quantity, this focuses on the amount of total revenue needed to reach the break-even point. It's useful when analyzing sales targets in monetary terms rather than units. Target quantity. Sometimes companies have a specific profit goal in mind. Target quantity helps determine how many units must be sold to achieve a desired level of profit after covering all costs. Target revenue. This calculates the total revenue required to hit a target profit. It's especially helpful for setting sales goals for the team and planning marketing or pricing strategies accordingly. Some other special topics. In addition to these, CVP analysis also includes topics like contribution margin ratio, margin of safety, operating leverage, and multi-product break-even analysis, all of which give managers deeper insight into business performance and risk. We will cover each of these topics in detail in the upcoming episodes, with clear explanations and practical examples to help you understand and apply them confidently. And don't worry if some of these terms are new to you. We'll break everything down step by step, so it's easy to follow, even if you're just getting started. The second major technique in decision analysis is marginal analysis, and it's actually the central concept that supports many specific business decisions. In simple terms, marginal analysis helps managers evaluate the additional benefits versus the additional costs of a particular decision. The word marginal just means extra. So we're focusing on the impact of producing one more unit, taking one extra order, or adding one more activity. Under marginal analysis, there are several types of managerial decisions, and each one is a real-life situation where this technique becomes extremely useful. Let's look at each of them in more detail. 1. Marginal revenue and marginal cost. This is the foundation of marginal analysis. It compares the extra revenue earned by producing one more unit to the extra cost of producing it. If marginal revenue is higher than marginal cost, the company should go ahead. But if the cost is higher, it may not be worth it. This basic logic is applied in many different types of decisions. 2. Sell or further process. This decision happens when a product can be sold in its current form or processed further for a higher price. For example, a company may sell crude oil or refine it into petrol. The question is, does the extra processing bring more profit than it costs? Marginal analysis helps find the answer by comparing the incremental revenue and cost. 3. Accept or reject a special order. Companies sometimes receive one-time special orders, usually at a discounted price. Should they accept it? Using marginal analysis, we check whether the special order price covers the variable costs and whether the company has idle capacity. If yes, even a lower price can still bring extra profit. 4. Make or buy. Should the company manufacture a component itself or buy it from a supplier? Marginal analysis compares the cost of making it in-house with the cost of buying it. It also considers any opportunity costs, like time or machine usage. The goal is to choose the most cost-effective option without affecting other operations. 5. Keep or drop a segment. If one part of the business is underperforming, like a product line or a branch, should it be discontinued? Marginal analysis helps us see whether that segment still contributes anything to covering fixed costs or overall profit. If dropping it reduces total profit, then keeping it may still be the better choice. 6. Maximizing contribution margin per limiting factor. In real business situations, companies often face constraints, like limited labor hours, machine time, or materials. When resources are limited, we use marginal analysis to prioritize products that give the highest contribution margin per unit of the constraint. This ensures the company makes the most profit possible from scarce resources. So, as you can see, marginal analysis is not just one tool, it's a decision making framework that helps managers in many different areas. Each of these topics will be explained step by step in the coming episodes with clear examples. The third important area of decision analysis is pricing analysis. This is where managers analyze different pricing approaches and market behaviors to determine the best price for products or services. Setting the right price is not just about covering costs, it's about understanding customer demand, competition, cost behavior, and strategic goals. In this section, we look at the key economic principles and pricing methods used in real business scenarios. Let's go through the major components of pricing analysis one by one. First, law of demand. The law of demand says that when the price of a product increases, the quantity demanded generally decreases, and vice versa, assuming other factors stay the same. In simple words, people buy less when prices go up and more when prices go down. This principle helps managers understand how their pricing decisions can directly affect sales volume. Second, elasticity of demand. Elasticity measures how sensitive customers are to price changes. If demand changes a lot with a small price change, the product is called price elastic. If the demand remains stable even with price changes, it is price inelastic. For example, luxury items usually have high elasticity, while basic needs like salt or medicine tend to have low elasticity. Understanding elasticity helps companies decide whether they can increase prices without losing too many customers. Third, pricing strategies. Businesses can choose from many pricing strategies depending on their goals and market conditions. Some common strategies include penetration pricing, setting a low price to enter the market and attract customers quickly. Skimming pricing, setting a high price initially, then lowering it over time as competition increases. Competitive pricing, pricing products similar to or slightly below competitors. These strategies help companies balance between profitability, market share, and customer loyalty. Nangavadu target costing. This approach starts with the selling price customers are willing to pay. From that price, the company subtracts its desired profit margin to determine the maximum allowable cost. The business then tries to design or produce the product within that cost. It's a market-driven approach that forces companies to control costs early in the product planning stage. 5. Life cycle costing. Products go through several stages, from development and introduction to growth, maturity, and decline. Life cycle costing looks at all the costs a product will incur during its entire lifespan. This helps in setting a price that recovers not just production costs, but also design, development, marketing, and end-of-life disposal or phase-out expenses. It gives a long-term perspective for pricing decisions. 6. Cost-based pricing. This is a more traditional method where the price is based on the cost of the product plus a markup for profit. For example, if it costs $100 to make a product and the company wants a 20% profit, the selling price would be $120. While it's easy to calculate, this method doesn't always consider market demand or competition. Seventh law of supply. This law says that as the price of a product increases, the quantity supplied by producers also increases, assuming other things remain the same. Higher prices motivate businesses to produce more, while lower prices may reduce production. Managers use this principle along with demand analysis to find the right balance between what customers want and what suppliers can offer. 8. Other special topics. In addition to the above, pricing analysis also includes topics like psychological pricing, like pricing something at $9.99 instead of $10, bundling strategies, dynamic pricing, prices that change based on demand and timing, like flight tickets, and value-based pricing, where price is based on the perceived value to the customer rather than just cost. Pricing decisions can deeply impact a company's revenue and market position. That's why understanding these principles is so important. And don't worry if some of these terms feel new. We'll explain each one clearly in the upcoming episodes, with real-world examples and simple illustrations. Keep watching, and everything will become easy to understand. Now, before we move deeper into decision-making tools, it's important to understand the concept of costs, because most managerial decisions revolve around controlling and analyzing costs effectively. Costs are generally classified into variable costs, fixed costs, and semi-variable costs. Let's understand each one in detail with simple examples. Variable costs. These are the costs that change directly in proportion to the level of production or sales. If you produce more units, your total variable cost goes up. If you produce less, it goes down. The cost per unit stays the same, but the total varies. Here are some examples. Direct materials. The raw materials used to make a product. For example, if you manufacture t-shirts, the fabric used for each shirt is a variable cost. Direct labor. Wages paid to workers based on the number of units they produce. So if you pay workers per item, more production means more labor cost. Variable overhead. Costs like electricity used by machines. The more you run the machines, the higher your electricity usage. Variable selling and administration. Costs like sales commissions, where the expense increases with the number of units sold. These costs are important for contribution margin analysis because they directly affect your profit for every additional unit sold. Next, fixed costs. These are the costs that remain constant regardless of how much you produce, at least within a certain activity range. Even if you produce 0 units, you'll still incur these costs. Some examples include fixed overhead, like factory rent or salaries of permanent supervisors. Whether you produce 100 units or 10,000 units, the rent remains the same. Fixed selling and administration. For example, the monthly salary of office staff or marketing executives who are paid a fixed salary not based on sales. Fixed costs don't vary with output, but they're critical because they create the break-even point, the minimum sales level needed to cover all costs. Third is semi-variable costs. Also called mixed costs, these have both fixed and variable components. That means part of the cost remains constant, and the other part changes with production volume. For instance, a telephone bill might have a fixed monthly rental plus variable charges based on call usage. A delivery truck might have fixed insurance and license fees, but fuel cost varies with the number of trips. Understanding semi-variable costs helps managers to break them down into fixed and variable components when making budget or pricing decisions. So to summarize, variable costs go up or down with output. Fixed costs stay the same within a range. Semi-variable costs have both behaviors. Knowing these distinctions is key when we work on cost-volume profit analysis, break-even analysis, and other decision-making techniques, which we'll explore in the upcoming slides. Now, let's take a closer look at the contribution margin income statement and compare it with the normal income statement. Starting with the normal income statement, as shown on the slide. First, we have sales revenue, which is the total amount earned from selling goods or services. From sales, we subtract the cost of goods sold, or COGS. This includes all the direct costs related to producing or purchasing the goods sold. For example, direct materials, direct labor, and manufacturing overhead. Basically, COGS covers all costs that are directly tied to the production of the product. After subtracting COGS from sales, we get the gross margin. This margin shows how much money remains after covering production costs, which can then contribute toward covering other expenses. Next, we deduct general and administrative expenses. These include fixed and indirect costs, such as office salaries, rent, utilities, insurance, and other overhead expenses not directly tied to production. We also deduct selling and distribution expenses, which cover costs related to marketing, sales commissions, shipping, and delivery. After deducting all these expenses, the result is the operating profit, also called operating income. This shows the profit from the company's core business operations before considering financing and taxes. Finally, we subtract interest expense, which is the cost of borrowing, and taxes, to arrive at the net income, the company's final profit. Now, how is the contribution margin income statement different? The key difference lies in how costs are classified and presented based on their behavior. That is, whether they are variable costs or fixed costs. Variable costs change directly with the level of production or sales volume. Examples include direct materials, direct labor, variable manufacturing overhead, and variable sales commissions. If sales increase, variable costs increase proportionally. Fixed costs, on the other hand, remain constant regardless of the sales volume within a relevant range. Examples are rent, salaries of permanent staff, insurance, and fixed overhead expenses. In the contribution margin income statement, we start with sales revenue as usual. From sales, we subtract only the variable costs. This gives us the contribution margin. The contribution margin shows how much revenue is available to cover fixed costs and contribute to profit. Then, from the contribution margin, we subtract fixed costs to find the operating income. Finally, we deduct interest and taxes to get the net income. So, to summarize, the normal income statement groups costs by function, like COGS, selling expenses, and administrative expenses, without separating fixed and variable costs. The contribution margin income statement groups costs by behavior, variable versus fixed, which helps in analyzing how costs change with sales and how much each sale contributes toward covering fixed costs and profit. This distinction is very useful in management accounting for decision-making, cost control, and break-even analysis. Now let's move on to the contribution margin ratio, or CMR for short. The contribution margin ratio tells us what percentage of each sales dollar is available to cover fixed costs and contribute to profit after paying the variable costs. In simple terms, it shows the part of sales revenue that is not used up by variable costs. The formula to calculate contribution margin ratio is contribution margin ratio equals total contribution margin divided by sales revenue. So, CMR equals total contribution margin divided by sales revenue. This ratio is usually shown as a percentage. Another important point is that the contribution margin ratio and the variable cost ratio add up to 100%. That means contribution margin ratio equals 100% minus variable cost ratio, where variable cost ratio equals total variable costs divided by sales revenue. So, if the variable cost ratio is 60%, then the contribution margin ratio will be 40%. This means 40% of each sales dollar is available to cover fixed costs and to generate profit. In the next slide, we will see an example to understand how to calculate the contribution margin ratio and how it helps us analyze profitability. Let's take a practical example to understand the contribution margin income statement and how to calculate the contribution margin ratio. Consider the following financial data for a company. Sales revenue is $10,000. Total variable costs are $6,000. Total fixed costs are $3,000. Interest expense is $0 and tax expense is $100. Using this information, we can prepare the contribution margin income statement step by step. First, we start with the sales revenue of $10,000. Next, we subtract the total variable costs of $6,000. This gives us the contribution margin, which is $10,000 minus $6,000, equaling $4,000. From the contribution margin, we deduct the total fixed costs of $3,000. This leaves us with an operating income of $1,000. Since the interest expense is $0, we move on to subtract the tax expense of $100. Subtracting tax from operating income leaves us with a net income of $900. Now, to understand how efficiently the company covers its fixed costs and earns profit, we calculate the contribution margin ratio, or CMR. The formula is contribution margin ratio equals contribution margin divided by sales revenue. Substituting the values, CMR equals $4,000 divided by $10,000 equals 0.40 or 40%. This ratio indicates that 40% of every sales dollar is available to cover fixed costs and contribute to profit. Let's quickly review what we covered in this episode. First, areas of decision making. We explored the key areas where management needs to make decisions, such as pricing, production levels, and cost control, which are vital for effective planning and controlling business operations. Second, decision analysis tools. We discussed various tools and techniques that help managers analyze alternatives and make informed choices, including cost volume profit analysis and break even analysis. Third, variable costs and fixed costs. We explained the difference between variable costs, which change with production volume, and fixed costs, which remain constant regardless of output, and why this distinction is important in managerial decision-making. Fourth, contribution margin income statement. We saw how this income statement format separates variable and fixed costs, helping managers understand how much revenue contributes to covering fixed costs and generating profit. Fifth, contribution margin ratio, CMR. Finally, we learned how to calculate the contribution margin ratio, which shows the percentage of each sales dollar available to cover fixed costs and profit, aiding in pricing and profitability analysis. Thank you for watching. We will cover each of these topics in greater detail in the upcoming episodes. See you in the next episode.